Hello, hello. Welcome to another episode of Financial Tides. This is your host, Taylor Perillo, Certified Financial Planner, and co-host John Perillo, Certified Financial Planner. Today, we're going to be talking about the value of an advisor. And this is an important topic for us because obviously we're in the business for a reason and we're looking to bring value to clients. So, a lot of the times when we're talking with clients and new prospects, they come in and the first thing that they ask about is the total cost. But when they look at cost, they're not looking at value as well and how that factors into the equation. So today we're going to dive into the true quantifiable value of what working with a financial advisor brings to the table. And just a little spoiler on that note, it's more than just the investment advice side of things. So that's the first thing that always comes to mind. But we're going to go into the details of how we can help clients avoid behavioral mistakes, manage taxes, building out personalized plans, keeping portfolios aligned with their goals, and delivering that real measurable value that we're going to be talking about. And a lot of this is from the research that we got from the 2025 value of an advisor study that states that an advisor, and we've said the number 3% for years, but they've revised it in 2025 now to the value being approximately 4.87%. So we're going to break down that number for you and tell you what it means and kind of frame where it comes from. So 4.87% is the number we're working with, and it comes from the framework of what's called ABC plus T. So those are the different value added areas that we're going to bring to the table as a financial advisor. So A being asset allocation and location, B being behavioral coaching, C being customized family wealth planning, and T being a tax smart planning, investing. And when you add those all together, that's what delivers that value that we're going to bring to the table and a financial advisor is going to bring to the table, which is roughly 4.87%.
Great. I think it's worth noting that this information comes out of the Russell Company, and it's the 12th annual study they've done of this. So they're not new at doing it, and it's a combination of behavioral things, as Taylor mentioned. But Vanguard also does the study, and they haven't updated it in a couple of years. So we're kind of sticking with the Russell study because they're looking at it really hard every year. I can't wait for the Vanguard and Fidelity ones to come back out because it usually reinforces exactly what Russell says here. So, apology for all the numbers we'll be throwing out, but the good thing is the visual slides will help you go through that and support because I think visual is better than hearing sometimes when it comes to decimal points and percentages and whatnot. But the first one is the A in the ABCT, and that's asset allocation. And the value of an advisor on that, I always thought it was going to be higher. Every year I'm surprised it's only 0.3%. And I think that's because there's just a lot of technology out there that can help a little bit with asset allocation. But the biggest thing we see here is what's called the comfort trap. If people are left on their own, they build familiar portfolios. These often consist of large cap stocks that are making the news, maybe a few bonds. The everybody owns fund, the everybody owns the ABC fund, and I gotta have it. Everybody else has it. And according to the American Association of Individual Investors, that's a really good organization, AAII. Self-directed investors keep around 20% of their portfolios in cash, and that can cause permanent impairment to your strategy because you're not keeping up with inflation if 20% of your long-term money is sitting in cash. Why? It feels good. It just feels, hey, I got my money in cash. I know it's safe, it's stable, it's liquid. Over time, it's a serious drag on long-term returns. And, again, we're showing some examples of a couple of portfolios. The advisor advantage here is it's not the advisor's job isn't to make you comfortable today, but rather to help you reach the goals in the future. And that's why we ask a lot of questions. We try to get all the facts. We make sure you're not overlooking small companies or international or emerging markets, and tailor the plan to you. Just like the pilot uses his flight plan for that flight, he might be flying that route in 2 weeks with a different group of people, and it might be a different kind of plan. So, and our job is to keep you invested through all market cycles by managing your emotions. So,
Yeah, and I think that level of diversification that we try to deliver, the real goal here is to smooth out the return and keep the clients invested through all the market cycles. So if markets are cyclical, and I think we'd all agree on that, if we can keep you invested, you're not guessing and you're not doing some of the things that we're going to cover on in the behavioral side of things, which kind of is that nice transition. So you'll see here that risk adjusted return is really where we excel. You'll see that we can bring a bit more annualized return for the amount of risk we're taking, and that's where the asset location and allocation really drives. But this is behavioral, is what I touched on before, and that's the real area where I think advisors drive the most value, and that's really what the study says as well, is that through behavioral coaching, a value of an advisor can add about 2.47%. And that's really just because of that emotional roller coaster. And behavior is the number one reason most investors underperform. So the data shows it from 2010 to 2024. The S&P 500 averaged about 13.88%. Make the number simple, you could call it about 14. And then the average investor, just 11.41%. Make it simple, 11.5%. So that's about a 2.5% shortfall, which you'll see here. And this goes back to a Carl Richards slide in his book called The Behavior Gap, which is the fact that an annualized cost to retail chaser, somebody that's doing it on their own and letting emotions take over, underperforms the actual indexes and what you're actually striving for. And why is that? It's because they make poor decisions, the retail investor. People are human. They sell when things look scary. I mean, there's been plenty going on in the Middle East, and people started getting worried about that. There was tariffs that worried people. There's always something that's going to worry people, and that causes people to sell. And then when things start feeling good again, that's when people will start to buy again. So they're missing out on all of the recovery if things had gone down when they sell, and they're not participating fully because they're out of the market during portions when things seem scary that the market's actually going up through. So we think that as an advisor, our role is to step in between that behavior that you're trying to make, help be the voice of reason, and stay anchored to your long-term goals instead of being reactive over an emotional circumstances.
yeah, I mean, I know you kind of covered that great, Taylor, but I was just reading something this morning about the 30% drop in 2020 at the beginning of COVID, and the fact that we finished the year at an all-time high. And I just thought about it. I said, somebody stole someone's wealth at that 30% down point or 29 or whatever it was. Somebody sold their shares and permanently damaged their wealth. And somebody bought those shares. And my thought was they're flying first class with the profits they made on that for the rest of their life, would have putting two more kids through college, grandkids through college. So, and but somebody was on each side of that transaction and behavior. Who was the one with the right behavior there? We know now, 5 years later. Um,
Complete self-sabotage is what I would refer that to. And hopefully when you have an advisor, you pick up the phone and talk to them before making that complete self-sabotage situation, not just go ahead and do it. So,
yeah, one of our fund companies calls it permanent impairment of capital.
yeah.
So another thing that the next one you'll see from us is that customized family wealth planning adds a value of 1.13%. I love how they come up with these, hundredths of a point, but they've been doing it for a while, Russell. But basically, the message is one size fits none. We've all heard the expression one size fits all, but this is one size fits none. Today's clients don't want generic financial advice. They want a personalized plan that reflects their goals, values, family dynamics, and lifestyle. And a lot of times, the balancing act we do is get a couple in alignment or a surviving parent and the children heirs, get them in alignment on their dynamics and lifestyle. One child may feel risk averse and not need to take the risk. The other one says, I got a lot of catching up to do and I'm going to work till 70. So I've got 14 years, so um, they're different. So we try to help them negotiate and navigate not just the numbers, but the complexities of real life. Job changes come along, aging parents need care, there's marriage, there's now we have gray or silver divorce that goes on. And we think those are areas that I can easily see why it's above 1%. Again, I kind of laugh when I see 1.13 and how is it not 1.14 or 1.12? But we'll take it under advisement from Russell. They've been doing this a long time. And now so we're becoming life coaches, I think. We help clients transition into retirement, but we also help them plan business succession. Like, guide them to say, hey, have you found someone to buy your practice? Can you get something meaningful for something you've built for a generation here, And if not, can you coach somebody along that in the business to run it or whatever, and you oversee and work one day a week or, so some of the things we do. And then I'd say the last thing is based on the difference between a low-cost robo platform and a full-service advisor who builds a comprehensive plan. The benefit goes beyond percentage. It's really a trust and a confidence issue. So a lot of what we get from people is they've done their stuff online, they've let AI help them, and then when something shaky comes along, they lose their confidence and make the mistake. If they have a trusted person they've worked with for a long time, they'll tend to come back and will weigh out the pros and cons of each. And it's not a robo scenario. These are your pros and cons, and these are your possible outcomes of each.
Yeah, and I think it's because it's a deep and meaningful relationship that we build over many years of working with our clients that a robo advisor will never really be able to replicate what we do because when somebody calls and say, "Hey, this is the situation that I'm going through," we not only know how their values are, what their family thinks, what they want, what their goals are, it's not just about the one investment or the short term. It's about knowing how our clients think that just a robo will never really fully understand. So, transitioning now into the last part of the ways that value is added is that tax smart planning and investing, which adds a value of about 0.97%. And this is a bit more quantifiable than just trust, clarity, and sense of direction like the last one. Taxes are actually an inevitable item that we all are going to have to deal with in some way, shape, or form, but they're not fixed. They don't have to be, you have to pay every dollar in taxes. You're going to have to pay some taxes. There's pretty much no avoiding that. Um, Government's going to get their money in some way, shape, or form. But every dollar that you lose to taxes is a dollar that's not compounding in your strategy and working for you. So it's really crucial that we work on tax smart investing strategies. And it's a way that gets overlooked a lot to increase returns. So advisors that are taking a proactive approach to taxes and looking at it ahead is really a dramatic way that we can reduce the tax drag on a portfolio. So we do things such as tax loss harvesting, the asset allocation and location. So where you're holding certain assets, you obviously don't want to hold municipal bonds in your IRA account. They make a lot more sense to hold in your after tax account, doing different charitable gifting strategies and much more. Just from reviewing a client's 1099 that they receive or a 1040 and working with a CPA to kind of uncover some of the opportunities that there might be in the tax situation. So anyone that's worked with us knows that we're often asking for a copy of the 1040 to go over with them and seeing what other items we can pull out of there to make your financial strategy more tax efficient. So, tax smart planning can reduce the portfolio drag by about 1%, which is where this number comes from. You'll see on screen here that $1 million portfolio is making, if you just are traditionally investing it and just throwing it into whatever sticks on average, this is what you'll see on the left hand side that you'll pay from dividends, you'll pay from interest income, you'll pay in the form of capital gains, and you'll end up with a pretty decent sized tax bill from that $1 million investment. And because of that, you lose about 2.1%. And these are just on average. So this is where that number comes from on the difference. And then a tax aware strategy, if you're minimizing the interest income that you're creating through a municipal bond fund and you're minimizing the capital gains by being in more tax efficient investments that aren't distributing capital gains out of it, you could really minimize your taxes and keep a lot of those investments that you're not losing money to taxes through the way that you're investing.
Great. And I always think of the fact that it's not just the portfolio that's tax efficient, but it's the goal setting, right? So if we're sitting down with you today and you say, you know what, always we ask on every agenda, it says anticipated big expenses, new car, etc. New car because that tends to be the biggest anticipated expense, more so than a roof or a refrigerator. But if someone says, yes, we need a new car in March of next year, we may look at it and say, all right, it's time to take out half that car in 2025 out of the portfolio and tuck it aside safely and take out the other half in January of next year. So we've spread that distribution and withdrawal out over two tax seasons, the 25 and the 26 year. Even though it may have been December and January, 30 days apart, it's two separate tax years. And so those are goal-driven approaches that get us there as opposed to just the portfolio itself. And then, in summary, Taylor pointed out taxes are almost 1%, 0.97. But the four items, the A, B, C, and T, add up to 4.87. And so people always wonder, hey, what am I paying for an advice? If you're using an engine online and you're doing investment advice, you might be at a half a point. With us, you might be at 1%. Do we think we add enough value to cover that 0.5%? If Russell's right, we're 4.25 ahead. If Russell's too generous for the advisors and it's really only 3.5, we're still over 2 point ahead. And if they're really way off and we're only 2.5 ahead, we're still over 1% ahead of do it yourself. So I think we can add enough value over time to easily cover that half a point difference between, the I'm doing it online with XYZ.com company or I'm working with you guys.
Yeah, and I think that's a real return on investment for clients. And I think the more that that compounds on an annual basis, the more powerful it actually is. So I think it's a really compelling story for us as advisors to be telling right now. So if you're a client and you've ever wondered, or a prospect that hasn't worked with an advisor in the past and ever wondered what you're paying for, the data's here. And we're not saying all advisors bring this value because we know that there's a lot of really good, talented advisors out there, and there's some advisors that are not as talented, not as planning oriented and delivering in all these areas. So we just want you to have an idea of a good advisor, somebody that does full financial planning like us. This is what you're paying for. This is what the cost of the amount that you're paying for an advisor really is. But we think it is net positive. You're not just paying someone to manage your investments, you're paying for guidance, discipline, strategy, and confidence. And when you do that, you're going to get a net positive value from the advice that we deliver. And
Great.
that
Thank
is
you,
all we have.
everybody. Yeah,
Yeah,
sorry, Taylor.
that's all we have for today for you guys. So thank you guys all for tuning into Financial Tides. We'll catch you next time.
Thanks so much. Have a great day.
John Perillo and Taylor Perillo are financial advisors offering securities through Cetera Advisors LLC, a registered broker-dealer, doing insurance business in California as CFGA Insurance Agency LLC, member FINRA/SIPC. Advisory services offered through Cetera Investment Advisors LLC, a registered investment advisor. Cetera firms are under separate ownerships from any other named entity. California insurance licenses number 0F60123 and 0M90666, 6265 Greenwich Drive, Suite 251, San Diego, California 92122. The views depicted in this material are for information purposes only and are not necessarily those of Cetera Advisors LLC. They should not be considered specific advice or recommendations for any individual. Neither Cetera Advisors LLC nor any of its representatives may give legal or tax advice.